Recent news headlines make hard reading for landlords. Buy-to-let mortgage rates are rising, profits are getting wiped out, and landlords are having to make tough choices. So, as a landlord, what can you do to minimise the impact of interest rate rises?
In today's episode of the Property Tax Show, we will share 5 strategies landlords can consider to maintain profits.
Hi, I'm James Poyser.
And I'm Nadeem, Head of Tax at Provestor, the Property Accountants.
So Nadeem, we've seen the headlines. We've seen interest rates are rising, inflation's rising, cost of living crisis, and all of this is putting pressure on landlords' profit. You and I have been chatting, and you've given me a list here of some strategies that landlords can adopt to try and soften some of the blow of these rises. So let's go through some of these. The first obvious one, Nadeem, surely must be increasing rent, right?
Absolutely, James. So yeah, this is a common conversation we're having now with a lot of clients, with the cost of living increases and of course rental costs going up with the mortgage interests. So one of the easiest strategy for landlords is typically just to put the rent up, because it's the quickest, easiest way for them to sort of counter the increase in costs, mainly the mortgage interest costs that they're suffering. However, part of our job is to explain the consequences of doing that in terms of tax and of course their profits and how that affects their tax return position or their limited company profit position.
And how do you mean, is it not straightforward? Your interest goes up by 100 quid and therefore you increase your rent by 100 quid? Is it not that straightforward? No,
it is, unfortunately. Tax is never as straightforward. And of course it has an impact in terms of your bottom line. So depending on what your tax position is, so your marginal rate of tax, whether you're a basic, higher, or you're a combination of both, because your profits push you into becoming a high rate tax earner, it has an impact in terms of actually your bottom line. So actually just reducing your profits, your rental income doesn't necessarily increase your profits in proportion.
Right, okay. So increasing rent isn't really straightforward because of the tax implications, and we're going to talk about that in the next episode of the Property Tax Show. So obviously make sure that you hit that subscribe button and make sure you're the first to know when that episode goes live. So are there any reasons why you might not put your rent up?
I mean, of course, this is a strategy. It's commercial advice. It's not necessarily tax advice. So there are many reasons why people might not want to put their rent up. Of course, they don't want to lose good tenants. They might lose a tenant, or they may not be able to justify any increase in the property because it may be a ceiling price already. So these are the kind of things we've got to talk about with clients, because there's sometimes you have no option but to maybe keep the rent as it is, and of course then suffer the consequences of the tax, unfortunately. Yes. But yes, the rent up is an obvious increase, but having to take commerciality within that as well.
Because I guess it doesn't take many weeks of your property being empty to wipe out any tax benefits of increasing your rent.
Exactly. Yeah. Absolutely.
Okay, so that's increasing your rent covered, Nadeem. The second thing that you've suggested is selling properties. Tell us more about that.
Yeah, and it's something we've covered in previous episodes, because it's a strategy stroke, commercial kind of decision in terms of selling some assets, and it's become more common now because of Section 24. And let's be honest, one of the reasons the government brought Section 24 in was to penalise landlords and to open up the property market for first-time buyers. So actually, it's pushing them to where the government wants them. However, actually, if you take a step back and actually think about what you're trying to achieve here, it's actually not a bad strategy to consider, because where we'll have clients thinking about potentially diversifying their portfolio in terms of different types of properties or using a limited company structure, one way of releasing some equity to do that is by selling some of your existing portfolio. Yeah. And what that requires us to do is maybe get involved with the client's portfolio, have a look at some of the weaker assets, properties which aren't making as much profit, the bad apples as there were, think about potentially selling them. Of course, understanding if there's any capital gains tax issues to consider and what that cost is up front, but actually how in reality you can use that equity to diversify your portfolio or spend elsewhere.
And I think that's a really good point, right? Because we've covered incorporation a lot, right? So taking a personally held property and incorporating it into a limited company, there's costs associated with it and you've got to do the business case. But this is subtly different, which is selling a property that's personally held that might be underperforming, and then buying a new property through a limited company that perhaps could give you greater yields and help you to soften the blow of the cost of making that move from personally held properties to properties held in a limited company.
Exactly, and let's be realistic about where these conversations have come from back in 2016 when Section 24 came into place, and the benefits of having interest-only mortgages aren't as there anymore as they used to be. So actually having these highly geared properties isn't as attractive as they were. So actually maybe using some of this equity on some of the properties you want to sell to offset some of the mortgages against the other properties will of course increase your cash flow potentially as well. So it's a business decision as well as a tax decision, but it's for us to sort of open these decisions up for landlords.
And I guess it's about getting back to the basics, right, of appraising your property to understand if it is commercially viable for you to invest, buy it and make a profit from turning it out to rent.
Yeah, absolutely.
Okay. Yeah. The next tip, the next strategy that you mentioned this morning was conversion of properties. So you were talking about the conversion of residential buy-to-let properties into things like furnished holiday lets. I think you mentioned service accommodation. I guess there's also HMOs. So tell us more about converting the type of property and why you might want to do that.
Yeah, I mean, of course, conversions have always been really popular, and typically commercial to residential has been very popular. But recently, so with COVID and stay-at-home vacations, of course, your service accommodation, furnished holiday lets have become really, really popular up and down the country, and actually they generally generate more income for you. So they're more attractive from a rental income and a business perspective, and of course you may incur a level of cost to convert these properties across. So those costs can potentially be deductible from your tax return and actually reduce your profits down. Okay. But actually it can turn a bad apple, which we just mentioned, into a high earning yield property. Yes. So again, it's almost taking a step back and looking at your portfolio and saying, well, Section 24 has put me in a break-even position, for example, and in reality, what can I do? Yes, sell it. Well, actually, you can go the other way and actually convert it into a higher earning property within your portfolio. And those are the things that we need to be considering with clients.
And I often hear you talk about furnished holiday lets, because obviously, a furnished holiday let is very different to running a buy-to-let with an AST tenancy. But I understand with a furnished holiday let, there's also different tax reliefs that are available to a furnished holiday let that wouldn't normally be available in a buy-to-let, is that right? Exactly,
yeah. And again, I think we've covered this in a previous property show. And actually, yes, there are a lot of benefits of having a furnished holiday, and obviously you need to meet the eligibility criteria to make sure it runs as a FHL. But if you do, then it's classified as a trade, and actually as a trade, as opposed to an investment, you get further tax reliefs through HMRC as well. So things like Section 24 mortgage interest is not impacted when you're talking about furnished holiday lets. Yes. And of course, if you've got a highly geared portfolio and you can transfer that to then maximise your mortgage interest relief, one option is to potentially convert the property into FHL.
Yes. So it's a double benefit, right? Because you would hope that your furnished holiday let should bring in more rent income, and then you've got the benefit of the fact that Section 24 isn't applying, more generous tax reliefs available. So it could be an interesting way to increase your post-tax profits.
Yeah, and the consultations that we cover, they're really important that we cover these types of things, because some of these properties are absolutely perfect for an FHL conversion. Some aren't, but clients really want to go ahead with the conversion. And so, getting some tax and some business advice to understand the consequences of converting some of these properties is quite important. So, tax, stamp duty, VAT, in terms of some costs that you might incur, and of course, capital allowances which are eligible as well, which we've discussed previously as well. So there's a number of things to cover when you're talking about conversions and having some sort of strategy in place.
So that's conversions covered, Nadeem. The next strategy that we've been talking about are things like deeds of trust, partnerships, incorporating portfolios. So I guess it's about thinking about the structure of your property portfolio. Tell us more.
Yeah, so again, I appreciate we've gone through some of these in previous episodes on the property show, but I thought it was a good time to bring these up again now, actually, because in reality, these are options available to minimise your tax. So the deed of trust is obviously a way of you changing beneficial ownerships of the properties, therefore splitting the taxable income between partners, and similar with a partnership, introducing another member into the business to actually split the percentages of the profits, and of course incorporation, which is moving your business into a limited company. And the reason I really wanted to raise them again now was because from a timing perspective, we may have had a number of conversations with the same clients about these things, but actually now is a real good time to bring these conversations up again, because you may have been put off with the costs, for example, of incorporation historically, but now you may need to revisit that and think, well, actually, it's probably time for me to consider doing something like this, even though the costs are quite high up front, because Section 24 is clearly having a bigger impact than we originally thought. Yes. So these kind of tools of tax, minimisation for in terms of a long-term strategy, I think really need to be considered again now.
Okay, and as you've mentioned, we've covered this on previous episodes of the Property Tax Show. So if you're on YouTube, head back, look at those previous episodes, and we've talked about partnerships, we've talked about deeds of trust, we've talked about incorporation. So there's much longer episodes available on those topics. Okay, great. So that's the structure of your portfolio. The final one is about reducing your income. Tell us more about this, Nadeem.
Yeah, so again, something we've talked about in the past and something which I'm assuming all our investors are aware of, which is the magic word of financially free and becoming financially free as a result of your portfolio and building your pot of properties, as it were. And, you know, everyone has a plan in place, whether they want to retire or semi-retire in 5-10 years' time. And when we have these consultations, we kind of have these conversations because, of course, the consultations are talking about the short term, but also have a long term plan in mind. And when we talk to clients about actually what they want to do in the medium long term, it's all about becoming financially free and retiring and going part time or quitting their jobs altogether. So actually, when we talk about Section 24, the cost of living, you know, prices and rental income increases, we have to counter that with their other earnings and their other income that they have at this moment in time, where we have these conversations, what we realise is that clients start realigning their long-term plans and maybe start thinking about retiring earlier or bringing, you know, forward their plans in terms of becoming financially free. And these are important decision-making things that you need to consider because, of course, if you're thinking about incorporating, there's a big upfront cost. But actually, if you're thinking about potentially retiring in the next 2 or 3 years, and that's going to significantly reduce your income in your personal name, you may not need to incorporate because actually your personal position may not be as bad in 2 or 3 years' time. So yes, you might have a higher bill in the next 2, 3, 4 years, but from a long-term perspective, you might be absolutely fine because, you know, you're retired or you're semi-retired. So, you know, again, I'm all about the medium long term as well as the short term. So having a consideration about what your long-term plans are, I think are just as important as what you're trying to achieve right now.
Yes, and we were chatting earlier on because bringing forward your retirement is one thing, but the other thing is if you've got the ability to, say, work a 3 or 4 day week instead of a 5 day week, and if you can afford to take that hit, it might be worthwhile doing. Particularly, you know, there's this really interesting kind of tax bomb that happens around the 100k mark, isn't there, where the marginal rate of tax is absolutely eye-watering, and it's greater than 40% as people think it might be. Do you want to just tell us a bit more about that and why it's a problem?
Yeah, and again, this is, you know, back to your original point about work-life balance. You know, yeah, we have these conversations about 3-4 days because it all kind of links together. And of course, then you're talking about the tax time bombs in terms of 50,000, where you start, you know, your child benefit starts to get taken away. You of course become a 40% taxpayer, and at 100,000, you start, you know, eating away at your personal allowance. So when you get to a point where all your personal allowance is eaten into, that's another £4,000 or £5,000 worth of additional tax that, you know, you're suffering. So and of course you've got, you know, child tax credit benefits, all the other things that go associated with your income increasing as such. And these are the kind of things we need to cover off with clients, so they don't necessarily understand the wider picture of what happens when your income goes over 100,000 and how your income goes over 100,000. So the Section 24 is a classic example because we no longer be able to deduct your mortgage interest. So where they think their income is below 100, actually in reality it's well over 100, and then all these consequences that are attached to it.
Yes. Isn't that an interesting consequence, right, of Section 24 could end up with people dropping out of the workforce or reducing the amount of time that they are working because the marginal rate of tax they're going to pay for that 5th day of work just doesn't add up.
Yeah.
It just doesn't add up for them.
That's right. It's a bit of a double-edged sword, isn't it, in terms of tax and obviously, you know, in terms of what the government would like, because they would, of course, like PAYE to be high and landlord tax to be high. But, of course, we're here to look after our landlords. And, you know, from a tax perspective, we want to make sure they're making the right decisions in terms of their portfolio and, of course, their own lifestyle. And that's what it comes down to, their lifestyle in terms of where they want to be and how we ensure that's, you know, absolutely tax savvy.
Yeah, fantastic. Great, so that's 5 strategies covered, Nadeem. Any other closing thoughts from you? So, you know, what is this everything that you think landlords should be doing and considering to help ease this crisis?
Yeah, I mean, look, when it comes to these types of things, I always say things change very quickly in the landlord market. And, you know, without talking about our consultations again, I think it's really important to get advice regularly because things are changing all the time. Tax changes all the time, but also your business decision process changes all the time in terms of your personal plans, and actually having a good up-to-date strategy is always quite important. So having some sort of medium-term strategy is really important for landlords to mitigate any taxes.
Yes, and I guess this is the first time we've experienced something like this, which is interest rate rises, inflation, cost of living crisis in the shadow of Section 24. So this is a very unique position that we've not been in before, and it is probably a good time to pick up your phone to your accountant and have a chat and make sure that everything is working as well as it can do for you.
Yeah, there's definitely more uncertainty in the market. There's been for a number of years. We knew this was coming in terms of Section 24. We didn't quite understand the impact of it in terms of the cost of living and obviously the rental market. I mean, the rental market itself is very buoyant, of course. So from a landlord perspective, the business is there. It's the consequences leading to what's coming around the corner, unfortunately.
Yeah, great, brilliant. Thank you, Nadeem. Thank you. That's it for this episode of the Property Tax Show. As always, put your comments below and Nadeem and his team will always be happy to help where they can. Make sure you subscribe and hit that bell button so you hear about the latest episodes. Remember, the next episode that's coming up is all about how to manage a rent increase and the tax impact of doing so. So that's it from Nadeem and I. Thank you for watching and we'll see you next time.